Hi, everybody. This is Chris with Invest LYH, and today I'm going to go through some basic market understanding of the real estate market in response to a tweet that I saw on Twitter that just kind of it made me have to do this video so that you guys do not fall into the same trap that many people out there are falling into. I'm going to go ahead and share the screen here. Give me just a moment. All right. So this was the tweet that I saw this morning. I don't know much about this lady, Amy Nixon. She's got a pretty prominent following on Twitter. And when I say I don't know much about her, is I don't know if she has an econ background or not. I would venture to say that she does not, based on what I'm going to explain to you today, because even having a few courses in econ, you should know this. This is basic stuff. But let's take a look at the tweet here. She says, let's see what's happening. What happened the last time we saw the blue line gap up in the short period of time? I've got this rhyme on repeat for a reason. What I think she's saying is like this blue line here is about the crash, whereas the red line will continue its trend. And the reason why she's saying that is because this point reminds her of this point here. So to her, 2006 equals 2021, which is a little weird because it's 2023, right? Which means that if I erase all this blue line should have already started coming down. I don't see that. I know a lot of you out there don't see it. And we've talked about the timeline or the linear line of prices, right? From zero to uh what we used to call like infinity, right? So we don't know what the end price. It's like what 140 million in like LA for a house, like the highest end house that's for sale at the market currently. Well, if these prices are falling and these prices are going up, the middle is doing what? It can either shift to the right or it can shift to the left, but generally speaking, these prices are increasing a little bit, which would make this blue point here, right? Either here or here, because this is 21 down here, right? And now it's 23. Oh, there we go. So on its face, this graph and this tweet is a little odd because it, we're in the future for this graph, and she's saying, "Oh, it's gonna fall." Well, it hasn't fallen yet. So let's get rid of some of these items here, right? So we can kind of take a look at this, and I'm just going to give you guys some understanding of how markets work and how economics works, right? Let me erase some of these guys here. So in any market, there is a supply and demand curve, right? And generally what happens is you have you have price and quantity. And as price increases, your demand for that quantity will decrease. So what that means is that this is going to be the demand curve. I'll change the color on it to orange, right? So you're going to want 1 here, whereas you're going to want 10 here because the prices are lower, so you can purchase more, right? But are you going to purchase 10? Are you going to purchase 1 if the price is too high? Well, that's where the supply comes in. And the supply is going to be this curve right here. Let me move this over a little bit. I got a little window here, and what happens is I can't see my screen. So let me get rid of that. And what happens is that the supply, right, the producers are going to produce less here because there's going to be less demand, and it's going to cost them more to produce that, whereas they're going to produce more here because their cost structure is lower, but the demand may not be where it is. So what happens is in the middle of this, where the two curves meet, that is where you get a price. Oh, That is where you get a price demanded. So that's the price that the sellers can sell it at and earn a profit. And it's also where you get a quantity demanded, right? So how many the general public will want. This is the housing market. These are the builders and these are the buyers. Okay? So this is a dynamic point. It doesn't stay the same every day. It changes daily based on more people coming into the market and saying, I'm going to pull the trigger today. I'm going to get a mortgage application. I'm going to talk with a realtor. So this is the basic understanding of how a market works. Okay? Something to consider here is, in economics, sometimes we call it temporal economics. And what that means is our decisions that we make are on a timeline, right? Time. Are we going to benefit from this in 1 day, 1 year, 10 years, or let's say 40 years? We make decisions based on this. So the reason why I wanted to introduce that is because when we come back to this tweet, we look at this and we say, okay, so the cost to buy right now is 26.97 and the cost to rent is 18.45. So we're assuming here, because there is assumptions here. We're assuming that this person who is making this decision based on this is making it for which one of these temporal understandings? We don't know. So it's up to the reader to make that assumption. Is this person purchasing on 26.97 based on a 10-year plan? Is it based on a 40-year plan? I'm looking at a house today. It's a sixplex and it is overpriced. It has 6 tenants, but I believe the market rate or the rents are under market. So do I care about this price when my income will exceed that by over $1,200? See, what this assumption is it's assuming that everybody's going to be in there for what? It does not tell us what that assumption is. It just leaves it to the reader. So she is just saying, oh, well, people are going to be moving in there and they have no understanding of how long they're going to be in there. So this blue market is definitely going to fall. That's not a very good understanding of how this market works. There is a time component to this, and unfortunately, I think that Miss Nixon does not understand that. The second thing to understand is kind of along the lines of the timeline, right? Is she says that this is going to fall, right? This blue line is going to fall. Well, I think a recent report said that 86% or 84% of people have 4% interest rates or lower. So you mean to tell me that somebody who has a 4% interest rate or lower is going to sell their house and then they're going to make up the decision of the 26.97 or the 18.45? They're going to sell their house. That's going to be step one. And step two is they're going to make a decision on between these two what they're going to do next. Are they going to buy another house or are they going to rent at this price? I just don't see that happening. Let's go back to the market, right, that we created here, and let's move it to the side, okay? In order for there to be a drop in this blue, right, price, which we determined over here, we got the orange demand curve and we got the blue supply curve, okay? In order for there to be a drop in price, look, I'm just going to ask you, and then I'm going to tell you what needs to happen. Either this demand needs to shift this way, right? Because if we put it here, now this new price, right? If we were to just draw it out, All right, price 1. Now we have the second price. Price 2. That is a drop in price. Okay, so demand needs to fall. Or in another scenario, okay, again, guys, this is basic economics here. Okay. In another scenario, the supply needs to increase. Excuse me. It doesn't need to go backwards, and the curve needs to shift outward. Right? Because again, this is a drop in price. So, which of these scenarios does Miss Nixon believe is going to happen? Does she believe that demand is going to fall, or does she believe that supply will fall? Because it has to fall at a substantial rate. It can't just fall like a little couple percentage points. I mean, it has to drop like 10, 15, 20% for prices to start dropping. Now, for new homes and new construction areas, I have seen prices come down because they build in, when you have a new home, right? You have cost, you have a profit margin, and anything extra. So what they're doing is they're saying, hey, what if we buy down the rate for, X minus 0.05? Well, we're still making the profit on this point right here. And if we sell enough of these, it'll make up for the loss here. So this is where people get it wrong when they're on Twitter. They don't understand these two dynamics here, that demand needs to fall, right? Fall, or supply increase. And unfortunately, if supply were to increase, it would alleviate a lot of these price constraints. But politicians do not like to help suppliers, because suppliers, if you are looking back at this market, right, of builders, right, there is this point. And in order for a builder to create a home, they need to figure out how they're going to pay for this. And oftentimes it's through some sort of loaning apparatus, which means the bank's going to look at this amount that they have and say, well, you need to put in this amount. And in order to put in this amount, let's say this is a 200K home. Let's say this is 20K, and the bank will loan 180 on this, right? This is for a builder. Well, that's for one home. What if they're building 10 homes? That is $200,000 that they need to put into the project. So if you have $200,000 lying around, what are you considered in a politician's eyes? You are considered wealthy, right? So if the wealthy control this curve, will the politician assist the wealthy in developing more homes? They will not. But what will they do? They will find citizens and they will say, well, we know that it's harder to buy a home right now, so we're going to give you a break and we're going to pay for your down payment. We're going to give you down payment assistance. So do you think that that's going to decrease demand, or do you think it's going to increase demand? If it increases demand, the curve goes outwards. And what happens to the price? Now we come to price 3, right? Now, if we assume that there is no decrease in demand, that's price 2. So what happens? The price increases. It puts upward pressure on the price, because now more people, if there's 10 people bidding for a home at 100,000, and we add 15 more people in here with an extra 10,000 for closing costs, what will happen to this home? The price will go up, right? This is where I cannot understand some people who talk about these crashes. In order, like some people, one person wrote on here and they said, oh, it's an asset bubble. Well, in order for an asset bubble to pop, we come back to economics. Supply needs to increase of that asset. if we come down here and we look at what they say about, where is it? Come on. In order for an asset bubble to pop, right? In order for an asset bubble to pop, the subsequent asset supply needs to increase, because as supply increases, prices drop. Well, if we have 86% of people in sub 4% homes, where is the supply coming from? If you're paying $1,500 on a home right now, where if you were to move out of that home, you were paying $26.97 on a new bill on a new home, or $18.45 in rent. Let's say it's just a 3-bed, 2-bath home, right? Where is the supply coming from? I just don't see it. I have studied economics for years. I have an advanced degree in economics. I'm currently pursuing a doctorate in business with a focus on real estate. I do not see this happening. I do not see this scenario where this comes down happening, because there is no supply. There will not be a supply over the next 5 years. How long does it take to build 100 homes? And do we not? The other thing too to consider about this, these market fundamentals that I just showed you guys right here, right? This is just the real estate market. What about the labor market? If you're building a home, can you hire the right workers? And are they going to require a higher wage, right? Are they going to demand a higher wage? If they demand a higher wage, the supply curve will shift of workers. If we put the supply curve of labor on here, they have a different wage that they expect now. So the supply of workers is shifting backwards, which means prices for wages are increasing, which means prices on the cost structure are increasing, right? Can you guys see where I'm coming from here on this? I know it's a long video. I hope you watched it fully. I just don't see this happening. I think that there is several things at play. There's the market is dynamic. I understand that some people like these little pictures and they think that there's, oh yeah, well, what must go up must come down. Well, does that play well with the market fundamentals? There is something to be said about a simple supply and demand curve. There are things that are outside of the market that do control them, but you have to monitor those factors. We oftentimes in economics, we talk about curve shifters, right? What shifts the supply curve and the demand curve? So let's say, for example, this is the last thing I'll go with. Let's say, for example, hot dogs, right? The cost of hot dogs to produce them has increased by 100%. Well, you're going to raise prices. And if you raise prices on hot dogs, what does that do to the bread makers who make hot dog buns? Right? Hot dog buns. They are going to shift from hot dog buns to hamburger buns. They're going to shift their resources because they know that in their market, the demand curve for those hot dog buns is going to fall downward because, right? So the quantity originally was right here, but the quantity has gone down. So they are going to shift their resources to hamburger buns. Why? Because of something outside of their control. The cost of the hot dogs caused the demand curve to shift. I don't see the supply curve shifting. I do see the demand curve shifting, and I see it shifting outward for real estate, which means the prices are going to go up in certain markets. Again, let's go back to our thing, right? First time buyer or entry level homes and luxury, or like last time, right? Middle's gone. We already know that. These prices are going to go up. So if you buy here over the next 10 years, your values are going to go up. Why? Because demand is shifting outward. Keep that in mind as you look. Don't buy any of my deals. I'm just joking around. But yeah, I know this was a long video. I'm going to stop sharing here. But I just needed to get this out so that I could have it on file. And I hope you guys understand that. I'm trying to teach you guys here the basics of a fundamental market so that you can just understand exactly how the market dynamics shift and change. The market is not a static market. It changes daily, and we need to understand that. The minute the state of Virginia or the minute the city of Lynchburg decides to add some sort of down payment assistance, your housing will probably go up 20% in the next 6 months. Demand will shift, which means the price of existing homes will go up. I hope you guys like this video. Let me know. Follow me on X, right? Is that what we're calling it now? I appreciate each and every one of you. Thank you guys so much for watching. Thanks.